Hi, this is Ken at Tortoise Capital. This is a review of the master classes from today's postings in the Patreon and chat room. The first one was from the nightly report. We took a look at the multi-time frame NDX summary, and there were some things we wanted to highlight from that. The first one was Boeing had an exceptional 3-day move when it's been underperforming the Dow 30 for every other time frame, so that's an indication of outperformance on a relative basis that makes it stand out from the rest of the from the Dow 30. In other cases, things that have been having good 30-day, 10-day performances also outperform. So Merck, United Health, and Pfizer in that whole healthcare sector become very interesting, which makes where's our healthcare? XLV, not surprisingly, doing very well. So you can either play XLV or play the combination of those three. But Boeing, at that remarkable move after long periods of underperformance, gives an indication that maybe it's starting to work. By the same token, 3M has been underperforming on the 270 of the 90, but now is a little more longer-term benefit or outperformance here on a 3, 10, and 30 days. So that's an area of interest. Merck is probably the easiest one to believe in altogether. Energy is one where we've had significant underperformance long-term, some moderate or short-term above-average performance, but then it's lagging still. So that's an indication of weakness and perhaps a return to weakness, and that turned out to actually be the case today when it got smacked down. And then oil exploration and metals and mining both have been underperforming long-term but have had a 10-day resurgence and are doing pretty well. So those are indications of recent buying interest at reversing the long-term trend, and so we're going to be looking for increased volatility and still no directional bias, but the possibility for some big moves in either case there. So that's the reasons for those highlights. This one was important today, and why we make such a strong emphasis about the relationship between swing trading and its timing, and then set you up well for day trade. So this is the trade that we closed on the 29th. It was 3 positions built on the short side in McDonald's when it had collapsed out of this long sideways quiet channel, crossed the 200-day moving average, and then bottomed out. But then on the 29th, instead of failing further, it opened with a slight gap up, closed well, and didn't make a new low. So that was a time to make the intraday swing exit to lock in the gains from that swing trade. And you gotta love McDonald's long term because it's been such a good stock for so long. It's like buying America, but it's deep into the winter. And so what ends up happening is this kind of a move where you have a rapid sell-off in the morning, and then with about $1 or 75-cent move off of the belly of the dragon, now you've got an owl entry and really a hybrid frog off the bottom, and then the winter, spring, right around here in the summer, you're starting to appreciate that one, and you have a PSAR flip, so you buy that one. It just keeps working. If you get out here, then you get back in there, but if you are respecting the 270 and the VWAP, maybe you hold that through there. I'm not offended if you get out, but as long as you re-enter. For our purposes, because we were starting this off as a swing trade, we wanted this to be a swing trade entry. We're holding 3, cash the turbo intraday piece, and then now we have a swing trade entry in something that's going to look really good on a one-day move in a stock everybody has to own that's on a 20% sell from its swing high, with an entry around 192.90, and we're holding a couple bucks of gains in there already. And then on a daily basis, that's what that looks like. So we closed the swing trade yesterday, leads into a reversal today. Now this is such an extreme move that we're playing back to the edge of the dragon, spine of the dragon, the 200-day moving average, where we wouldn't be surprised if there was resistance. Far side of the dragon has to get through there in order just to revert to the mean. And then the long-term region is in this 210 to 213 or 214 piece. But in terms of a one-day pop with a swing trade, that's really you're buying on the value side of a company that everybody has to own, and the one-day move pays for the swing trade. So this is that's like free chicken. You notice the long-term fair value. This had been so strong for so long that 220 is still the fair value. It has just now recently started to roll over, and that breakdown from that Z3 pinch, to me, this one is going up. If you believe in America, and really I'm looking at the PSAR flip at 213. So you have an opportunity for about a $20 or a 10% move from here, and it's already started well with markets money to buy that initial swing position. So that's why I'm liking McDonald's. I should show that whole package there. Okay, so that's the today's masterclass. Thanks for your kind attention.